Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the difference between a professional and amateur investor. And this idea to sort of do this podcast and write this blog was really stimulated by a blog written by Seth Godin, who is a US author, presenter and entrepreneur. And if anyone that knows me knows that I'm a big fan of his work. And if you have an interest in marketing or business or even just human behaviour, I suggest you subscribe to his daily blog. It's not always fantastic, but fantastic more often than not. And if you just Google Seth blog, it'll come up. Anyway, his recent blog was really about the difference between amateurs and professionals. And I think this topic and subject relates perfectly to investors as well. So if you think about, how does an amateur approach investment versus a professional? And so what I've done, and you'll see it in the show notes, is I've taken the time to kind of list some example behaviours of professional investors and example behaviours of amateur investors. So some examples of a professional investor would be, they understand that making investment decisions requires experience, education and understanding the market. It seeks out an expert in their field who's willing to pay a fair fee for their advice. We'll have a methodology for hiring and firing professional advisors. A clear list of things that they want and want to avoid, and ensure that these advisors have thorough methodologies. They'll hold their advisors accountable for producing results. They won't try and take on tasks that are outside their sphere of expertise. That's when they'll go and find the right person to give them that advice. They make investment decisions on a daily basis, and they will take almost any steps to ensure they don't make a capital loss. That Buffett's first rule of investing is don't lose money. Second rule is refer to rule 1. They don't lose money. So that's kind of the hallmarks of what a professional investor looks like. Now, that could be a wealthy individual. It could be a fund manager. It could be someone that works for an institution. Now, let's look at an amateur investor. Typically, an amateur investor has no metric or methodology for measuring the value of advice. They don't really understand where the value of good quality advice lies. They ask friends and colleagues for advice. They're prepared to have a go and try and do it all themselves. They consider it a saving if they work it all out themselves and therefore don't need to pay someone else for their advice. To some extent, they're guided by emotions. Either it feels right, or they fall in love with the potential returns, or they like the particular property, for example. They get seduced by investment returns and don't adequately consider and mitigate investment risks. I often think amateurs are blinded by returns and don't even for a second think about what can go wrong. And good quality investors will always think about what can go wrong first before they even consider what is the potential upside. They don't realise the danger of their lack of experience. They make a handful or less of investment decisions over their lifetime. Remember, the professionals making investment decisions daily. And they're prepared to make a mistake. That is, they'll think, I'll have a go, and if it doesn't work out, then maybe I'll reach out for advice. A professional investor would never do that. Can you imagine someone employed going to their boss and saying, look, I stuffed this up because I thought I'd have a go at it, but it didn't work out. They would lose their job. So I thought it was interesting to kind of list out, what does an amateur investor look like? What does a professional investor look like? Because we don't often think about it like this. The interesting thing is that imagine if your friend told you that they did their spouse's dentistry work, or they wrote their own will. I mean, most of us understand that would just be ridiculous and stupid when we just don't have the skill and understanding to do our own dentistry work, and we would never try it. Instead, in that regard, we reach out to a dentist that is well qualified and has possibly been referred to as someone that we get along well with and we trust. And psychologists refer to this as conscious incompetence. That is, that we know we have a deficit of knowledge and experience, and it's too risky to try and do it ourselves. So we consciously know that we're incompetent. just because you can do your own financial planning, do your own tax return, structure your own loans and so forth, doesn't mean you should. We can do our own dentistry too. It doesn't mean that we should. More importantly, maybe people have really misunderstood their role in managing their own finances. I don't think for most people their role is to figure it out themselves. Really, I think their role is to hire the best people they can afford to help make the smartest possible decisions. That's what we do in other aspects of our lives. If we need a will, or we need some dental work, or we need some medical work and so forth, or we need some tax advice. And it equally applies to investments. Now, I hear people saying, that's great, Stuart, but how do you find good quality people? You're putting a lot of trust and faith in them, and it could be some time, 5-10 years, before you can work out whether they've been right or wrong, whether they're the right or wrong people, and whether they're actually going to help you get to where you're going. I think it is inherently difficult if you don't have a methodology for choosing people, selecting the right advisors, that is. Now, I do it in my business. That is, that there's in the professionals that we utilise to help our clients, buyers agents, commercial property advisors, lawyers, and so forth. So I have to go out and find the right people that are going to help, that I'm going to trust, that I can use personally, firstly, and then secondly, that I can refer my clients to, that I know they're going to help my clients. And so I think we can take this professional and amateur lens and apply it to selecting the right people. I think that's probably the best thing, because in a professional environment, we're going to have a methodology and process for appointing an advisor, finding the right advisor. A big corporate's going to have that, and it's going to be robust, and they know that their key success factor lies in their people decision. You know, which advisor, which firm do we choose? If they get it right, they win. If they get it wrong, they lose. So really, that's what you need to get good at. That's what you need to have a robust methodology on. And I think there's 6 things. There's 6 things that I look for in choosing the right advisor, and the right advisor has to have all 6, and there can't be any compromises. So let me take you through those. So the first one is, how do they make their money? You know, it's important that I'm working with a business that is strong and sustainable. There's no point working with an absolute low-cost business that doesn't really have a sustainable business model, because if I embark on a relationship with them, they might not be around in a couple of years' time to really help me see out the plan or see out the investment. And it sort of ties in with the accountability point, which I'm going to talk about at the sixth consideration that I'm going to talk about in a second. So I want to understand their business model. I want us to understand how they make money, and I want it to make sure that it doesn't contradict with my goals. I want them to make a fair profit, but nothing more and nothing less. Less than a fair profit means they're not sustainable. More than a fair profit means I'm getting ripped off. How they get paid should be nice and transparent, easy to understand. You know, if there's any complexity or opaqueness there, I'm not comfortable. And alignment of goals, that is, probably the most perfect alignment would be that they only make money when I make money. That's often referred to as a commission. That's often not appropriate. But, you know, I want to make sure their goals aren't contradictory to mine. So how do they make money? Very important to understand. Secondly, is there overwhelming evidence that the results will be good? So, you know, I've written about evidence-based investing before in the past, and essentially there must be strong evidence that utilising their particular investment methodology or approach will drive quality returns. So there needs to be strong evidence, and in the absence of evidence, there's just too much risk, and I'm not willing to take that risk. Number 3 is, hand in hand with number 2, do I understand what's delivered their returns, what's driven their returns? So I need to understand the methodology and then really understand those past returns. And I need to ask myself, what has driven them? Is it luck and good timing? Is it the market? Or is it their skill in intellectual property? Is it their IP that's working? And obviously I'm only going to pay a fee for the latter. I'm only going to pay a fee for their intellectual property, but I need to make sure that I need to marry up the returns with how they've approached it and make sure that's going to work. Number 4 is longevity. How long have they been in business? There's 2 reasons why that's important. Firstly, if you've been in business for many years or decades, you've seen it all. You've seen different market conditions, you've seen lots of different client situations, you've seen lots of client problems and challenges, and you've learnt from all those experiences, and so you can bring those learnings to your client. So longevity is important. And secondly, if you've built a sustainable business, and particularly in investment space, if you haven't delivered returns in the long run, you're not going to keep clients for the long run. So, it provides quite a strong level of social proof. Number 5, they've got to have exemplary ethics and morals. And this might feel like quite a difficult thing to ascertain, but doesn't mean that it's not important. Just because it might be difficult to ascertain, you still need to focus on it. So I only work with good people that have pride in what they do, that they want to do a good job and they get a real kick out of helping people that are honest, open and transparent. They'll always tell you the good, the bad and the ugly. They'll tell you something even if they know you don't really want to hear it, and they'll always put their clients first. The only way, or the best way, I think, of ascertaining whether a person has exemplary ethics and morals is just look for the signs. Sometimes, if there's signs through their language or actions, even no matter how small that sign is, that contradicts, those exemplary ethics and morals, be concerned, because the right people will never contradict. The right people have a very strong theme of trying to do the best, trying to do a good job, trying to do work that they're proud of, and so forth. And choosing the right people, only working with good people, really critical. Okay, number 6 is they've got to be on the hook. Accountability makes a big difference, right? So if I can give someone a bit of advice and then I'm never going to see that person ever again, I'm not really on the hook for the advice, because the advice might turn out, or it might turn out poorly, or it might turn out well, but you know what? I'm not going to be around to take responsibility for it, so, I'm not on the hook. So that's why I think long-term relationships work better. I want my advisor to be on the hook. If my advisor said, go and buy this commercial property or structure your will like this, I want them to be around in 20 or 30 or 40, whatever years it is, when... the will's a bad example because I'm not going to be around to hold them accountable. But, the investment example is a good one. If, buy this investment, 10 years it hasn't worked out, I want them to be on the hook there to sort of answer the questions. Because if they are, they're going to take a lot more pride, a lot more responsibility with how they're behaving, and they're going to be aligned to my goals, which my goals are long-term. And I want their goals to be long-term, not short-term. Short-term could be, I'll just make some money off this client and move on. That's a short-term approach. I want them to be on the hook longer term. So that's really what I would consider a professional methodology for selecting the right people that are going to help you build your wealth and make the smartest financial decisions now and well into the future. And so I think it's a good opportunity for us to sit back and go, okay, when we think about a professional investor and an amateur investor and all the things that I kind of listed out, which side am I sitting closer on? Am I acting professionally, that is, I'm trying to find the right people to help me, or am I trying to do it all myself, thinking that I can have a go and, if I make a few mistakes, no big deal. Anyway, I hope that's been useful and a bit of food for thought. As always, if you enjoy the podcast and the blogs, please do share with anyone that you care about. The more people that listen, the better it is, as far as I'm concerned. And until next week, bye for now.